welcome. I'm Austin Shepard. I'm President and CEO of Fiduciary Trust Company, and we're delighted to have you here today for our 2026 Market Outlook webcast. We hold these every quarter as an opportunity to review dynamics that are going on in the investment markets and the economy, not only to look at the past quarter, but more importantly, to focus on opportunities and risk that are ahead of us. And as everybody, I think, is aware, we will be busy this year as we were last year. To help make sense of these markets and to offer our perspective, I'm joined here today by our Head of Investments, Pat Donlon. Pat, are you there?
I am. Good to be here, Austin.
Excellent. Our format for today will be, I'm going to turn it over to Pat to walk through some prepared comments and some slides. And then I will join Pat at the conclusion to go in a little bit more depth with some specific questions and answers. So with that, let me turn it over to you, Pat.
Thank you, Austin. So let's dig into the charts here. So the fourth quarter, we had another solid quarter for financial assets to cap off what was a really strong year across the board. We had non-US equities as the top performers, almost doubling the return of US large and mid-cap. Every major equity asset class delivered double-digit returns for the year. Fixed income delivered strong returns. Investment-grade corporates were up about 7.5%. Municipal bonds, if we looked at them on an after-tax basis, would be about the same, about 7.5%. We're showing them pre-tax here. Now, despite strong returns and stock prices across all major indices hitting all-time highs, we've got consumer sentiment, at least as measured by the University of Michigan survey, basically at all-time lows. It's even lower than we've seen in most prior recessions. Now, there are a couple other consumer surveys out there. I will say there's one from the Conference Board that doesn't look quite as dour as what we're showing here, but that one's focused more on the job market. The Michigan survey is more in the realm of personal finances. So the questions on that survey are things like, hey, is now a good time to buy furniture or a refrigerator, for example? So why is there this disconnect between financial markets and consumer sentiment? And we think the answer is the economy is working very differently across households. So higher wealth and higher income cohorts have benefited disproportionately from rising asset prices, while lower wealth households continue to feel pressure from cumulative inflation since the pandemic and still elevated borrowing costs. So we're shown here in the left chart. This is the top 10% of US households by wealth. They've seen their aggregate net worth rise by roughly $36 trillion since the end of 2019. And that compares to about a $2 trillion increase for the bottom 50%. And much of that $2 trillion increase for lower wealth households has come via housing appreciation. So real estate's about half of the total assets for the bottom 50% of households, more like 15% for the top 10%. So those gains are obviously far less liquid, harder to access unless you sell your house or you take on additional debt. In the top right, we're showing that interest rates affect households differently depending on balance sheets. So among higher wealth households, cash balances materially exceed consumer debt, meaning higher rates translate into higher interest income on deposits and money market holdings. And by the way, we're showing here just consumer debt, so variable rate debt. We're excluding mortgages since those are fixed rate and immune from interest rate changes. But in many ways, the higher net worth cohort actually benefits from higher rates. And if you contrast that with the lower wealth households, they tend to carry more variable rate consumer debt than cash. So higher rates show up quickly in their credit card interest payments, private student loans, or home equity lines of credit. And then finally, consumer spending is increasingly being driven by higher income households. So the highest income quintile, highest 20%, accounts for nearly 40% of US total consumer spending. And the lowest quintile accounts for less than 10%. So as a result, when you have strong asset markets and solid returns on financial assets, that can support aggregate consumption data that looks pretty good, even as a meaningful portion of households are reporting ongoing financial strain. And we think this theme of affordability, and especially housing affordability, is going to be central for this year's midterm elections. So housing affordability remains near multi-decade lows. That's from the combined impact of higher mortgage rates and substantial home price appreciation since the pandemic. Now, the administration's come out multiple times, even going back to the beginning of last year, that improving affordability is a priority. President Trump's actually expected to outline some proposed housing initiatives later this month at the World Economic Forum in Davos. So part of that affordability issue is getting rates lower. That's definitely a key part of the administration's agenda, both to ease pressure on households and also just to reduce the government's growing interest rate burden. So the president gets to appoint a new Fed chair this year, and that chair is going to inherit a notably divided Federal Reserve. So we're showing here the December dot plot from the Fed's December meeting. And the median Fed member expects just one rate cut next year, but you have 7 members that see either no cuts or even a rate increase next year. And then the outlier to the low end is Stephen Myron, who we talked about many times on these calls. He believes 6 cuts are warranted for 2026. So this K-shaped economy is a good example of why the committee is so divided. So higher rates are stimulative for certain households, while causing strain for others. And there's also some conflicting data when we look to the labor market. So if you look at some of the most widely followed labor indicators, job market actually looks to be on relatively solid footing. Initial unemployment claims, for example, those remain at in line with post-pandemic norms. And job openings actually have finally started to tick higher, which is consistent with other small business surveys that show a modest rebound in hiring plans. But if we're looking for any potential early kind of warning signs in the labor market, there's certainly a lot of angst right now around artificial intelligence and its potential to displace a lot of workers. So the bottom right chart here, we're showing we are beginning to see AI explicitly cited in layoff announcements. So we're looking at the Challenger job cuts report. August was the first month in 2025 in which AI was named as a primary driver of layoffs, and references have continued each month since. There's a notable spike in October, which is a big month overall for layoffs. But in aggregate, we'd say these layoffs remain pretty modest, around 50,000 year to date. And for some context, that's in a year where total layoffs were around 1.2 million. So not a big number in the grand scheme, but something we're monitoring closely as AI adoption continues to broaden out in the economy. And then it could be the case that AI isn't necessarily causing layoffs just yet, but it's inhibiting job creation in the first place. And so the bottom left is a chart we've shown before. The unemployment rate for recent college grads has been trending higher, and the gap between that rate and the broader unemployment rate continues to widen. And that's a very unusual development. If you look back throughout history, usually recent college grads have lower unemployment than the broad all worker number. But given that many AI applications today most closely resemble, or their capabilities most closely resemble those of entry-level tasks, we think this might reflect firms are kind of reassessing their junior hiring needs as workflows evolve. So we think AI will reshape the labor market, but not permanently shrink it. There's been a lot of doomers out there thinking we're all going to be replaced by AI. But we think if you look back through history, the labor market has always evolved alongside technology. So if you go back to the year 2000, the US employed roughly 160,000 video rental clerks, like Blockbuster or Hollywood Video employees. You had nearly 70,000 photo finishing workers, for those of you who remember getting pictures developed. And those jobs have basically vanished as streaming and Netflix, digital cameras, and then iPhones took hold. But at the same time, employment has surged in other fields. We show here nurse practitioners, information security analysts, data scientists. That's a role, the data scientist role didn't even appear in the official BLS data until 2018. And so it's likely that 10 years from now, we'll see a similar pattern play out. Some jobs will get displaced by AI and will fade over time. There'll be new categories, which may not even exist today, that will emerge, scale up, and help offset those losses over time. And so AI, very important topic, not just for the economy, but for markets as well. One of the more notable market-moving developments in Q4 was Google or Alphabet's release of their latest AI model trained on their own custom chips rather than NVIDIA GPUs. And that announcement came in early November, and it really set off this investor debate around the competitive positioning within the AI complex and contributed to the sharp divergence that we saw amongst the Mag 7 names. So the AI trade basically shifted from this highly correlated rising tide lifts all boat type of trade off of the April lows into a more competitive and potentially zero-sum type of environment. And there's some valuation math that helps explain why the market may be getting a little more selective amongst AI-related companies. So this chart here is showing the market cap of what we would broadly define as the AI complex since the release of ChatGPT in November 2022. We include the S&P 500 for context. What we're showing here is the cumulative increase in market cap or market value for the AI complex is already comparable to the high end of Goldman Sachs estimates for the present value of all AI-related revenues. There's a lot of assumptions going on here, but the point is, if Goldman's estimates are even directionally correct, there's really no room for additional value creation at the aggregate AI complex level, meaning future gains are more likely to come through a redistribution amongst those companies rather than the group as a whole. So one company increasing in value means another company is decreasing in value. And we walked through the underlying assumptions and some of this math in more detail in our Outlook letter for those who are interested. And then to close here, I just want to hit on a couple of fixed income points. So I mentioned in the last Outlook video that we think longer duration muni bonds look really attractive. We actually saw that start to pay off in Q4. Long duration munis outperformed. So we had longer muni rates fall, despite treasury yields, by the way, being essentially unchanged during the quarter. So as rates fell, the prices of those bonds increased. And despite that increase, we still think investors have an attractive entry point in long duration munis. So we're showing here the tax equivalent yields for AAA rated and BBB rated muni bonds. BBB is the last rung of investment grade. And really, a lot of the longer maturity muni market is lower rated, closer to BBB than AAA. But investors can get a 7.5% tax equivalent yield on a 15-year BBB rated muni, or 8.5% if you went out 20 years. I think that's really attractive. If you compare that to, say, high yield corporate, it's today about 6.5% yield, albeit with a shorter duration, but we think a lot more credit risk in high yield than in investment grade muni bonds. So with that, I'll hand it back over to you, Austin.
Thank you, Pat. I appreciate those comments. Let me start off by maybe diving a little bit further and more around the extension of a trend that happened last year. Specifically, you talked about the S&P 500 having a return of around 17% over 2025, and the international developed and emerging markets almost twice as strong, a little bit less than that, about 32%. And so I guess a natural question is, do we foresee international, the developed worlds, continuing that trend of strong returns? So Pat, I'd love your thoughts on that.
Yeah, we do. So despite the very strong performance in 2025, if you look at international equity valuations, we entered 2025, they were 2 standard deviations cheap versus the US compared to the 20-year average forward PE discount. But even after doubling the performance of the S&P 500 in 2025, there's still more than 1 standard deviation cheap relative to US equities. So, and it's important to note, that's relative to an average discount of about 15% So we're not saying or predicting that we think international equities are going to trade at the same valuations as US large and mid cap. But we're saying maybe 15% is when you lose that valuation tailwind. We've got 20% upside from here in terms of multiple expansion before we hit that. Uh, so valuation, I think that tailwind's still in place. And then the other one is the currency. And that's a big component, is a big component in 2025 to help boost returns. We still think the administration has a preference for a lower dollar. And if you look at the dollar, it's overvalued versus most major currencies on a purchasing power parity basis, despite a 10% decline in 2025. So we think currency can be a major factor for return when it's working in your favor, and it'll be a little volatile, but we think the currency tailwind and the valuation tailwind are both still in place.
Good. I guess related to sort of things outside of our domestic confines, we've had over the past couple days and past week a global event that will impact markets, and that is Venezuela. And so, Pat, I think we look at, as a firm, we think about both short-term and long-term perspectives. And when there is an event like this, we sort of also evaluate how the markets will deal with it, particularly in this case, relating to the energy sector. So what should we be thinking about as it relates to Venezuela and to investments and positioning portfolios?
Yeah, and so it's interesting you say that. A lot of times the initial market reaction is surprising and almost seems incorrect. And Monday was kind of no exception. So first day of trading after the event, the entire energy complex was up pretty big. Oil prices were up, which is kind of surprising because the prospect of opening up Venezuelan oil, you would think is going to actually lower oil prices. And sure enough, by Wednesday, just a couple days later, oil prices were down for the week. Chevron was lower than it closed on Friday. And so I think the market finally got around to realizing this probably isn't great for oil prices going forward. Meaning it's going to lower oil prices. The names that are still up, there are some, the Gulf Coast refineries, so Marathon, Valero, for example, those were built to process the heavy crude that comes out of Venezuela. So it makes sense that those are still doing well. As far as kind of go forward on the energy complex, if you look back, Venezuelan peak oil production was over 3 million barrels per day back in the 70s versus under 1 million today. And we've seen estimates, though, that it may take $100 billion worth of investments, maybe 5 or more years to get back to that level of production. And we think that there's a lot of companies that probably aren't in a huge rush to get back into that country until there's some geopolitical clarity in place. So that's our thoughts on the energy market. I don't think there's a trade to be made there necessarily right now. But longer term, one of the takeaways is it's pretty clear the U.S. is making this hardline return to the Monroe Doctrine, protecting the Western Hemisphere. And there may be some potential opportunities. We're looking at a country like Brazil, for example, that is a little more investable than Venezuela. Venezuela is not in the MSCI Emerging Markets Index. It's a frontier market according to MSCI. But Brazil is about 4% of that index. And they've been deepening their economic ties with China, which we know Trump doesn't like. They've got an election coming up in October. So that's one that we're doing some work on now to see if we can uncover some opportunities there.
Interesting. Well, more to keep us active on that topic.
Mm-hmm.
I guess the final topic I wanted to sort of spend a little bit of time on, and this is been a big driver of the S&P 500 returns over the past couple of years, is our developing thoughts or perspectives regarding the Mag 7 and the Mag 7 stocks. And to that standpoint, as we've talked about in the past, before the Mag 7, there was the FANG stocks, which was Facebook,
Mm-hmm.
Amazon, Netflix, Google. And that eventually evolved into the Mag 7. And based on the performance over the last 12 months, it seems like the correlation of great returns or continued returns is varying or splintering across those. And so, Pat, what is your general thought around the influence of the Mag 7 on the overarching market this upcoming year? And two, does this inform your thoughts as it relates to our standard mantra around diversification, right?
Mhm.
And that over longer periods of time. So I'd be interested in your thoughts on that.
Yeah, and they still make up a very large percentage weight in the index. But you're exactly right. If the group didn't have the Mag 7 moniker coming into 2025, we certainly wouldn't be calling them that on the basis of their 2025 performance. So they got the name in 2023, and if you go back to the performance of 23, all seven companies outperformed the S&P 500 by very wide margins, at least double the performance of the S&P 500. 2024, all but Microsoft outperformed the index. And then 2025, only two of the seven companies even outperform the index. Not so magnificent. And I think that they're going to continue to fracture. And there's a big event on the horizon here for the second half of 2026 that I think might accelerate that. And that's OpenAI's potential IPO. So OpenAI is the creator of ChatGPT, and they're rumored to be eyeing an IPO in the second half of this year at a possible $1 trillion valuation. So, assuming they achieve right now, their latest financing round is a $750 billion valuation. So they're already pretty close. But this would make them a top 10 company in the US by market cap. As soon as they file their S1, which is their registration statement for their IPO, investors will get a full transparency into their financials. And I think it's really going to increase the scrutiny on them, but also all the large public companies that they've signed deals with, Oracle, Amazon, almost all the Mag 7 companies, actually. And then some they're competing directly against, and most notably Google and Meta. So I think their IPO is going to bring major implications for pretty much all the Mag 7 companies, and maybe most directly Microsoft, because Microsoft actually owns a 27% stake in OpenAI. So we're $270 billion if the company does achieve $1 trillion valuation.
Well, that was certainly something to look forward to, or to I guess, in the middle of the year, which will be, again, material impact both on Meg 7 and the markets as a whole. So thank you, Pat, for that, and also puts a good marker out for us for things to look forward to in the next 12 months. We will be busy. Pat and the team will be busy monitoring those, and will be joining us in the second quarter as we continue to navigate these changing dynamics. If you happen to have any questions, feel free to reach out to your fiduciary investment officer or Sid Queller, whose contact information we will be posting. We provide these again as an opportunity to share thoughts and perspectives. And so again, thank you for joining us, and we look forward to seeing you again.
I encourage you to access some of our knowledge through insights on our website, fidtrustco.com, as well as by reaching out to your fiduciary trust officer or to Sid Queller at 617-292-6799 or at queller@fiduciary-trust.com. Thank you again for joining us, and we wish you and your family health and well-being.
The opinions expressed in this material are as of the date issued and subject to change at any time. They discuss general market conditions and trends and should not be construed as investment advice. Any reference to specific securities are for illustrative purposes only and are not intended to be and should not be interpreted as recommendations to purchase or sell such securities. Nothing contained herein is intended to constitute investment, legal, tax, or accounting advice, and you should discuss any proposed arrangement or transaction with your investment, legal, or tax advisor. Copyright Fiduciary Trust Company.